Welcome to today's session. Michael, maybe we'll give it a couple minutes just before we get started. We'll get everybody through the door on this beautiful, warm Tuesday evening. But today we're going to be talking all about top asset picks during these volatile markets and some opportunities that some investors will hopefully have in this time. Maybe I'll give a brief introduction to myself. My name is Akshay Iyer. I'm one of the wealth advisors on the team here at Sarwa. My focus is, working with clients, helping them, figure out their investment plans, dive a little bit deeper into their portfolios. I've actually been working with Sarwa for about 3.5 years and look very passionate about what we're doing here. I'm actually a licensed and qualified advisor with the Chartered Institute of Securities and Investments and also the Canadian Securities Institute. And super excited about today's session. I'm also joined by my colleague, Michael Chu, Mr. Michael Chu, who is Sarwa's head of investments. Michael, maybe if you want to give everybody an introduction to yourself before we get started.
Yep, thanks, Akshay. Like Akshay mentioned, I'm the head of investments. I've recently joined Sarwa in September. Previous to Sarwa, I was overseeing investments at a multifamily office. Before that, I was with ADCB on their investment team. Prior to that, with HSBC, both here and in Canada. So yeah, I am here to help clients try to make sense of their investments, what's happening, and obviously try to offer some insights and maybe some direction on where the opportunities are.
That's awesome. Thank you, Michael. So look, everybody, thank you for spending your time with us. We're going to try to make sure that it's worth your while. Today's session is really focused on what's actually happening in the markets right now, what real investors are doing as opposed to what the markets are doing, and how you can approach the current environment, not just with some more understanding, but actually with confidence. Because at the moment, headlines are very overwhelming. So we want to make sure that you come out of this with a lot more clarity, a lot more confidence about your own investment situation. And what we're going to cover today, right? By the end of the session, we're hoping that you're going to have a clear understanding of what's driving today's market movements. As I said, real examples of what different types of investors are doing. We actually have live data from a Sarwa client base to see what the investors are actually doing. And not only just that, we've also looked at global inflows and outflows. You can see where capital has been moving. Also some ideas on how you can position your own portfolio in this specific type of environment. And I would say a general framework on how to think through opportunity, even when volatility is high. I think a lot of times when there's volatile markets, the usual standard advice is stay calm, continue to invest, all of that sort of stuff. We want to dive in a little bit deeper. We want to provide you with a bit more of a framework on how to structure a potential portfolio even when volatility can be high. But what I also want to say is, as always, this is not personalized investment advice. This is ideas, examples to help guide your thinking. And another disclaimer is that this is, as I said, it's not, we're not going to be speculating on the markets. Myself and Michael, unfortunately, don't have a crystal ball. We don't know exactly what's going to happen with the markets tomorrow. I think this time more than ever, nobody knows what's going to happen with the markets tomorrow. So if you're here for market outlook, we unfortunately will not be able to give you specific times to buy and sell because we have no idea when when the right opportunity will be for that. And as I said, the second thing is it's more about don't take this as one-on-one financial advice. We're going to give you more of a framework and some guidance. But if you do have any questions about your own individual circumstances, we are going to go through a Q&A process also. So we're going to talk for maybe 20-30 minutes. We're going to do the rest of that time in Q&A. So please leave some questions in the Q&A feature, or feel free to reach out to our team directly, and we'll be more than happy to guide you and have a one-on-one conversation. Awesome. So that is all the housekeeping and kind of what we're going to cover today. So Michael, I'm going to pass it over to you now just to discuss, with everybody a little bit more on where the markets are today and kind of what's been happening with them and why it's been happening.
Perfect. Thanks, Akshay. I will just share my screen and just let me know if you can see that. Let's get back to the main.
Yes, I can see
Perfect.
the screen with a lot of colorful lines.
Yes, it's a bit messy. I guess you can say it's like colorful spaghetti. But one thing that we can guarantee, and we've seen it from the beginning of the year, that it is going to be volatile. Unlike the previous couple of years, we've had fairly fairly smooth with some volatility. This year, we've seen lots of volatility, and we're kind of looking for smooth and calmness, but I don't really think we're going to get that. Maybe within the next 90 days, we're going to have an opportunity to kind of rebalance, rethink our strategy, look at some of the spots where we can find some opportunity. But basically, this chart kind of shows us where most of the major markets are. I mean, year to date, gold has had a banner year. End of last year, it was on a strong run up, and this year, today up over almost 22%, pretty fantastic. I guess kind of like last year's laggards were developed markets ex-US. Year to date, up almost 7%. Fixed income, it's doing what they're expected to do. A little bit of a challenge, but again, compared to the broad equity markets, it made sense to have a bit of fixed income. Surprisingly, the emerging markets, VWO, is holding up this year as well. And then we get to the major developed markets, MSCI ACWI, which is the all world country index, is down almost just over 4%. S&P 500 down just over 8%. NASDAQ, QQQ, almost 11%, and Bitcoin, about 13%. So we can see that most markets are challenged, but this picture is I guess, a really good illustration of why diversification works. Why we are big proponents of diversifying across different markets, different regions, different asset classes, because we can't predict which one is going to be an all-star performer. At the beginning of the year, if you told me gold would be up 20% in the first quarter, just after, I wouldn't believe that, because gold generally doesn't move in those big moves. If you told me Bitcoin would be up 20% in Q1, I'd say, yeah, possible. Not a bad idea. With the other developed markets, not surprising, QQQ down 11%. These are, tech stocks are generally very volatile during, any kind of market movements. They go up quickly, and they can come down quickly as well. I guess that gives us an idea of where the markets have been this year to date. I guess some of you may be asking why. What's happened? Why are we seeing so much volatility? I guess a lot of volatility really comes from uncertainty. As investors, we want to have some certainty. We want to know that generally geopolitics are okay, countries' economic policies are okay, the economic engines are running in a fairly efficient manner. What we've seen so far is anything but certainty. If you read headlines, you will probably see that there's a flip-flopping of economic policy, from tariffs on, tariffs off, exemptions in different sectors, and adding more tariffs to different countries on a weekly or daily basis. So that really is what's causing a lot of the volatility. And then part of those tariffs and trade wars ultimately could drive up US inflation, which is still the largest equity market we're looking at. And as inflation increases, and as the trade war gets protracted, global growth concerns come into play. We've seen this during COVID. The entire world is very globally connected. If there's a slowdown in the US, the rest of the world will feel it. If there's a prolonged trade war, different countries will ultimately start slowing down, and globally we're going to see probably just muted growth figures, and that's not really conducive of strong equity markets. I guess that kind of sums up the why and where we are in the why. Akshay, do you want to kind of share with our viewers what some of our data is showing us, or what some of our Sarwa clients are doing in this situation like this?
Yeah, of course. Look, obviously gonna happy to do that. And it's interesting you said, right? Because the overarching theme seems to be uncertainty. Like that's always there. But within that, there's a lot of, different crosswinds, if you want to put it like that. The
Yep.
tariff tensions with China, the Fed's interest rate path, AI and tech repricing. So there's so many things that are going on. And this is something, like how are real investors responding to what's been happening in the markets? So we looked at real data from investor portfolios and some of the, maybe before even going into the specifics of it, I would say we've seen three common investor profiles. And, let's look at trend A, the sort of risk on optimist out of, the sort of investor profiles we'll see. And these are investors who've seen this dip as a buying opportunity. And I would say, especially in sort of tech and AI, a lot of them are rebalancing into, tech heavy ETFs, things like you mentioned, like the QQQ NASDAQ, semiconductors. We've seen people putting in a significant amount more into their portfolios after seeing some of these pullbacks of, 10% or so in a month. So I would say still long-term view, but very high conviction, right? These are people who are quite solid with their reasoning as to why this might be the case to go forward with. I'd say trend B, the other type of investor, somebody who might be like a bit of a hedge seeker. These are more cautious investors. They want to reduce their volatility or they want to protect recent gains. They tend to increase allocations to things more like short-term fixed income instruments, treasuries, things like gold. Obviously, Michael, you mentioned GLD, gold market ETFs. We're seeing this a little bit more common with pre-retiree investors as opposed to ones that have longer time horizon. They know that, maybe they have a shorter time, so they want a smoother ride for the next maybe 6 months to 12 months. Not to say that that's going to happen. We have no clue. But, just a little bit more stability for the next little bit is what some people are after. And look, one of the other ones, and not to say that, these are the only three investor profiles that we've been seeing, but this is also quite common, more of the long-term diversifier. Some investors during this time, and I've actually had a lot of conversations specifically today about three separate conversations about people who have almost taken this last few days and last, couple of weeks as a reminder that their portfolio might have been overexposed to the United States and maybe a little bit overexposed just to technology stocks. So they've started to look a little bit wider, to maybe global ex-US ETFs. They've looked at international markets. I think we're going to go into this a little bit more also, Michael, in terms of some opportunities, but, they're looking at things like Europe. They're looking at things like China. So diversifying a little bit further, mostly from a geographical standpoint, but also trying to diversify further from a sector perspective and also from an asset class perspective. So this is what
Yeah.
we've seen, more as general real investor profiles. But when we actually look at, where the flows are going, right? What's been happening with, the actual both Sarwa flows and then also global flows. And I think this, might not surprise anybody when we look at, some of the percentage of traders. So our, more actively traded securities on the platform. The number one, Michael, I don't know if you can guess it. I think a lot of people maybe in the audience might be able to guess it, but do you have an idea?
Oh, it's a toss-up. It's probably Nvidia or Tesla.
Oh, well, good. So number one is Nvidia, number two is Tesla. And by the way, I wasn't asking that as hypotheticals. We just pulled the data, so I was just checking if Michael, had an idea, but very accurate. Good thing you're head of investments. Now,
Oh, I think, especially Tesla, it's one of the most talked about stocks. Nvidia, it's really driving the AI evolution. Those two of the Mag 7 are serious movers of the market, and when they falter, we all feel it. So that's why it's up there.
yeah, exactly. Look, so Nvidia number one, majority of investors on Sarwa trade are trading Nvidia. Number two is Tesla. Now, Tesla's maybe a more interesting one because I think out of all of the companies that we've looked at, over this period of time, they have been hit the most severely, and a lot of that to do is sorry, more to do with market sentiment. There's obviously some more underlying factors as a result of that. But when you see the sort of price fluctuations with Tesla in comparison to a lot of the other Mag 7 stocks, there's a pretty big difference right there.
Mhm.
And obviously, like we'll kind of go into that in some more detail after, but those were the two top traded stocks. But then we started to go a little bit different, right? Number three out of all the actively traded things is actually not a stock, it's not an ETF, but it's Bitcoin, right? So a lot of traders are now shifting, their momentum, their mindset to potential cryptocurrencies. And I think what's even maybe not even stranger, but it kind of goes in the opposite direction. Number four, VOO, so broad market ETF. So
Mhm.
just in these, the top four, some are concentrated in, heavily sector specific, large cap specific, US specific, technology specific companies. Others are looking at cryptocurrencies, others are looking at broad market ETFs. So it is quite varied, but I would say the common theme tends to be US focused predominantly. It tends to be some popular cryptocurrencies. And then the US focused ones that are there, a lot of it is actually tech focused, right? And specifically Magnificent Seven focused.
Yep.
Another one that's also,
We've been living in an era of US exceptionalism. I'm sure you've heard that term or read about it, where you really couldn't go wrong by over allocating to the US. And I think actually we've had some conversations in the past few months, maybe near the end of the year, with some clients really asking, why do they even need any other equity market? Why don't we just invest 100% in the S&P 500, VOO or SPY? And this is kind of the reason why is even having a broad index ETF like the VOO, S&P 500, SPY, it's only 500 stocks in the ETF. Now, granted, those 500 companies will probably drive a lot of global revenue. But as we see now, if there's a slowdown and there's a significant impact to the US economy or trade relations, that market, the US market, the S&P 500, will be impacted significantly.
oh yeah, 100%, right? And I think once again, right, we always will advocate for diversification as sort of the crux of any solid, robust investment philosophy or sort of portfolio construction method. But right, zooming out, right, that I was just talking now about specifically what's happening with Sarwa trade users. So, the people on this call likely. But when we zoom out and look at it more from the broader market flow data,
Yep.
there's a few things that we've seen, right? And one of the things is energy financials. They have seen some strong inflows over the past 30 days. That's one
Mhm.
thing. These tend to be more defensive sectors. So a lot of capital has been flowing towards that. Now, the other thing is the reason for that is some investors are betting for higher, for longer rates that ultimately will benefit banks. So there's a whole, market dynamic to that, and that's the reason why, financials have been doing quite well. But also defensive sectors, right? Healthcare, consumer staples, utilities, these are picking up, typically a
Yep.
sign that investors are bracing for volatility. And then, we just went over it, right? The tech industry or AI, it's seeing pretty healthy pullbacks, but
Mhm.
there are some steady inflows on the dips. So we
Yep.
are seeing, even though capital is being pulled out, we are seeing investors also start to flow capital in certain other sectors. And there's a bit of a sector rotation, and that tends to happen during times of volatility. But Michael, maybe we can go through, each of these charts
Yep.
and kind of go into more of the potential investment opportunities and what they mean for people, during
Mhm.
times of volatility.
Absolutely. I think this chart is probably one that a lot of our trade users will be familiar with in some way, shape, or form. They're probably holding any one of the Mag 7 or QQQ, the NASDAQ, Bitcoin. So we should probably be familiar with the movements of the chart. What we're seeing is that a few months ago, or even mid last year, we're all questioning, where are the Mag 7 stocks overvalued? Have they been extended? Maybe. We've seen a revaluation. We've actually seen most of the PE ratios of the Mag 7 stocks to be more in line with the S&P 500. So, I mean, this is truly a case of if you owned it 6 months ago, you should probably be buying more of it. Be it, Tesla, Microsoft, Nvidia. Microsoft really doesn't make anything. They produce software, there are web services. There's not a lot of export or import risk to them. Apple may have dodged a bullet because they've got an exemption now.
Just saw this,
So
yeah.
yeah, that probably took a lot of lobbying from Tim Cook, maybe a signal message or two to the administration to get that through. I mean, Tesla's challenged because it's more public backlash on Tesla and Musk himself, and then also where they're manufacturing. But a lot of the rest of the Mag 7 will probably sort themselves out one way or another. So again, be selective, do your research and just have a look at which ones of the particular Mag 7s are going to be a little bit less impacted by a prolonged trade war with not just China, even Canada, Mexico, and the EU. You want to look for companies that are fairly resilient in this space. I guess we can move into the next chart, which is kind of a subset. It's not, it's part of the AI revolution. And we're talking about, an opportunity in cloud computing and cybersecurity. Two of those subsectors are really supportive of AI and how things are moving. If you've watched the recent show on Netflix, Zero Day, you will know that a serious hacking threat to any developed financial market can be a serious problem. So cybersecurity is going to be top of mind for most institutions. And as investors, we should be comfortable. We should understand that companies need to spend on cybersecurity. It's becoming a serious threat now. I mean, was it a few months ago, a hacker group made off with over $1 billion in Ethereum? I mean, we're not seeing armed robbers like the movie Heat walking into banks anymore and carrying duffel bags of cash out. It's all digital. You get teams of hackers and they're going to employ AI to do the hacking for them. And now it's going to be AI bots versus AI bots. So we really want to make sure those cybersecurity firms are, at the top of their game.
Yeah.
It's crazy.
Yeah, and it's really interesting you say that, right, Boo? Because with global cybersecurity, I think one of the key things that maybe a lot of people don't notice or know at this point in time is that global cybersecurity spending for companies is a non-discretionary expense, right? They are required to have, the cybersecurity practices in place, and a lot of them follow these subscription models. So
Mhm.
they tend to be a lot stickier, right? It's constant, consistent revenue that these companies make on a regular basis
Yep.
and their requirement to actually have. So I know on the chart that you have over here, right? So there's four ETFs and four tickers that all represent, different things. So CIBR is actually a cybersecurity, it's a first trust NASDAQ cybersecurity ETF.
Yep.
And you look at that, the performance in comparison to SPY, which is the S&P 500, in comparison to QQQ, which is a NASDAQ tech heavy ETF. And then obviously SKYY, like that is a cloud computing ETF, First Trust
Yep.
Cloud Computing ETF. But the difference is quite significant, especially when you look at cybersecurity versus cloud computing. And I think the cloud computing maybe falls a little bit more in line with your more traditional tech firms in terms of how they've been hit. But
Yep.
that comes a lot of opportunity too, potentially. But it's interesting to see the sort of difference between
Mhm.
something like cybersecurity versus cloud computing.
Yeah. And these two, cyber and SKYY, actually really complement your NASDAQ because there's not a lot of overlap. So, if anyone was to use a combination of these four ETFs, with knowing that what they're holding and where they invest, there's not a lot of overlap, and it would actually round up pretty well for your US exposure, tech heavy exposure. And if we just zoom out a bit, since this chart doesn't have a lot of, you can see the 1 year performance on that. I mean, SKYY was just through the roof when we're really gung-ho with the AI space. We're talking about hyperscalers really deploying capital to build out their capacity, all of the cloud apps. When I spoke to a lot of portfolio managers about what they're thinking is going to happen to this year, they said last year was really the AI build-up. We're building out the infrastructure. It means the server farms, the hyperscalers are building the infrastructure. This year should be the software and application phase. And we're seeing that. We're seeing a lot of new models come online. Existing models are updated on a weekly or monthly basis, and we're seeing new entrants like the DeepSeeks of the world. They're going to do it faster and cheaper. And that really shocked the market.
Yeah.
But I don't think anyone can really be surprised, because we're talking about technology. We're talking about software. Software can be rewritten into making it more efficient and use less resources. It just takes time. And as these models get more and more advanced, I'm pretty sure the AI model or agent is just going to rewrite their own software to make it better and more efficient. So yeah, this is probably going to be, some of the key trends and themes we're going to be watching over the next few quarters.
Yeah, and it's really interesting you mentioned DeepSeek, right? And I think that was the first wobble that the big US tech companies faced earlier this year, is when DeepSeek actually, when it was revealed that they were able to, replicate these models at a fraction of the cost. We saw
Yep.
that Nvidia took a pretty big beating in a short amount of time. And I think that was the first, wobble off the mark. And I think we're seeing a much more expanded version of that right now. And I think that's why we go back to, this is why people were saying that a lot of these companies, analysts and economists were saying that they were overvalued, because, if these sort of shocks to the system, they're not just isolated to right now, they've happened a few months ago too. So it's going to be interesting to see where we pick up over the next few months and quarters. But I think volatility is something that is likely here to stay, not to say that for sure, but I think that is why we want to go through some of these things that actually present opportunity during these times.
Yeah. I mean, look, Nvidia was the king for a while, and in the hardware chip space, they are still king, and their order books are still full. These server farms that are purpose built for AI are still being built and filled to capacity. And it's not like because we have a DeepSeek model coming to market, we're not going to be using that server capacity. It's still being utilized. We're still running backlogs. I mean, if you can make that software and the models more efficient, maybe they won't have to scale and build as quickly, but everything that's already been deployed is going to be utilized for everything. And as the models get better, it's just going to be better and better for the everyday consumer.
Yeah, look, 100%. I think that's always something that the market is we're gonna feel it in the market, I think, on an ongoing basis.
Yeah.
So I think, look, we obviously covered some potential growth opportunities, right, Michael? We talked about things like, US tech heavy stocks. We also talked about cybersecurity ETFs. We talked about, the cloud computing ETFs. Now, I'd say these are more growth focused opportunities.
Yep.
Now, there's also going to be people who want some more stability opportunities, as we mentioned in our investor profile. So what are some of the more traditional, defensive sectors that people might see opportunity in at this point in time?
Yep. Defensive sectors. Perfect. There's generally right now there's three very defensive sectors. And there historically always been these three sectors that are very defensive in terms of any kind of market volatility. And we have XLP, which is representing the consumer staples space. XLU, the utilities space, and XLV, which is the healthcare sector. And we can see the year-to-date chart that versus the S&P 500 versus the NASDAQ, they have performed very well. Most of the 2 to 3 are positive for the year. Healthcare is a little negative, but compared to the broader market, they're doing all right. So investors, if they're looking to kind of stay invested in equities, but dial down the risk a little bit and move into more of the traditional kind of boring sectors, these would be the sectors: consumer staples, healthcare, and utilities. And one really good website that gives you a nice visual breakdown of all the sectors within the S&P 500 and how they've been doing on a year-to-date basis. You can look on a 1 year, 5 year. Is this it's called the Select Sector Spiders, and this is sector spiders like SPDR. They're manufactured and distributed by State Street. So really good website. Their ETFs are pretty solid at tracking the index, but I think this gives us a good idea of where are we standing, which sectors are we looking at. No surprise that the technology and communications and consumer discretionary are performing probably the worst we've seen in a long time. But those consumer staples, healthcare, and utilities give you a good idea of opportunities. And as some of our clients may want to actually look through. The reason I like this website, it gives you actually the actual holdings breakdown in that sector. So it's really straightforward to use. I quite like this. But you can see consumer staples, Dollar General, they're a dollar store in the US. They're up 20%. And this just kind of shows you the mindset of what's happening. I wrote about this in this week's LinkedIn post. It's something called the wealth effect, because most investors are quite heavily invested in the stock market. If they see the stock market move 10 or 15 or 20% down, they feel 20% poor, and automatically they're rethinking where they should be spending money. Are they going to be making large purchases, or are they going to tighten up their boots and look at different options? Walgreens, Dollar General, all these are what we call consumer staples, everyday goods that people will need through and through.
And it's really interesting because the reason why I like this site also, because it shows a very clear comparison as to why some of these sectors obviously are performing better or worse than others. Now, if we go more specifically to the why, right, Michael, you have healthcare over here. We just talked about consumer staples. A lot of these things are requirements, right? They are not luxury purchases, or they're not, things that are so impacted. A lot of, healthcare, for example, consumer staples are very focused on domestic, outputs, as opposed to, having a huge reliance on international trade. So the tariffs at this point in time are not impacting them to the same level that it is impacting tech. Very similarly, when you look at utilities, what are utility companies? Power company, energy companies. These are companies that, it's a requirement. Usually when there is, market volatility, doesn't really matter. You still need power, you still need energy, you still need water, you still need these utilities. And historically, you ask any, hopefully any advisor, any economist, what are defensive sectors? These traditionally are the defensive sectors. It's not like this time is different or anything. There's reasoning as to why that is, but they historically are defensive sectors. We mentioned it also with financials. Banks also sometimes, they tend to be more defensive, right? When you look at it at financials compared to tech, there is a pretty big difference, but they still are suffering a little bit. But year to date, negative 2.44 is not the same as, negative 15.
Yeah. So, I mean, the financials are separated by a few different things. There's the big banks, there's the insurance companies, Berkshire is in here, and Progressive's an insurance company, I think AIG. So a lot of the insurers are kind of like you mentioned, good or bad times, you have to buy insurance.
Yeah.
Some of the larger banks might be a little bit challenged because there might be fears of a recession brewing, so they're looking at their non-performing loans, what's their consumer debt looking like. So it's a very odd place to be right now, where we still have inflation creeping up, or the risk of that creeping up. The Fed not really able to notch that rate down as Mr. Trump has wanted. And then we're seeing growth slowing down. So not an ideal situation right now. So we're definitely would look to be clients that don't want to stomach any volatility. The defensive sectors are probably where they want to be.
Exactly. And I think, maybe as the last one we go over, we've talked, I think, quite a lot about more US focused.
Mhm.
But I think it'd be good to also paint a little bit of a picture as to what's going on with international markets and how some investors can diversify a little bit further from the US. Let's say if they want, and this goes with twofold, right? So Michael, you've got the chart up over here now. We're looking
Yep.
at things like IEUR, FEZ, MCHI, FXI. So IEUR is basically a European developed market ETF that covers around 1,000 European stocks. FEZ is also a European ETF that
Yep.
covers the top 50 European stocks. Now, these two have done, pretty well so far this year, right? If we look at it on the charts in comparison to SPY, which is the S&P 500, they
Mhm.
are, looking positive year to date. And, FEZ, which is the more concentrated European stocks, have done, a little bit better because, usually that sort of concentration of risk will hopefully prove to have a higher reward. But this started from the get-go, right? Like they were performing really well at the start of the year.
Yep.
And I think, traditionally when you look at developed markets like Europe, they tend to provide maybe a little bit more stability. But I think at this point in time, they look like growth plays. Now, is that future outlook to stay the same? Nobody necessarily knows exactly, but really interesting to see how that places in comparison to the US market, which historically has
Mhm.
always been the thing that roars. But, at the moment, we're obviously seeing the inverse of that. But when we look right below that, and I think these are, these ETFs are kind of bang next to each other also in terms of performance. But MCHI, that's about 500, that's an ETF that covers 500 Chinese companies, right? So
Yep.
also relatively solid performance year to date, 8.13%. I'd say that is very solid so far, just in a couple of months. And then FXI is the top 50 large cap Chinese companies situated in China. And also solid performance year to date. The Chinese market was doing very well prior to all of this, taking obviously a little bit of a hit, but has bounced back over the last couple of days. And I think this is a great opportunity for investors that want to diversify a little bit further, from
Mhm.
just your, country specific US or, sector specific US stocks or ETFs. Because these don't just cover one sector, right? They cover obviously one geography that's outside of the US, but they cover a broad amount of sectors. So you're very well diversified from a sector standpoint, which is interesting.
Mhm. And as users or investors, these are also ETFs. You can use these ETFs as inspiration if you don't want, MSCI China, which is 500 stocks, or MSCI Europe, which is 1,000. You can actually just peel back and look at the top holdings of the actual ETF, and look at names that maybe they have an ADR that you can trade on the US exchange. A lot of investors like Alibaba. That is a staple in China. It's been challenging in the last few years, but with the Chinese equity market, with a bit of a rebound, albeit everything's challenged in the last couple of weeks, but we're seeing a lot more interest from foreign investors in Chinese equities, and we're seeing the Chinese government and policy very supportive of the Chinese companies. It's going to be an interesting space to see and watch over the next few quarters as well.
Yeah, and I think we were talking about this actually, Michael, right before we started the webinar. The next 90 days I think are going to be very interesting in terms of what happens. But I think, this is an opportunity for a lot of people to shape their portfolios. And I think it's really a good opportunity to start thinking a little bit more about how, what you kind of want to get invested in and how you want to diversify a little bit further or concentrate a little bit further. But look, I know that we've obviously been discussing the opportunities for a little bit of time now. So I know that we've got a couple questions also. So maybe before we move on to the Q&A, I'm just going to summarize exactly what these opportunities that we've mentioned. And more high level, look, obviously with what's been happening with the markets and with these tariffs, there has been, a pretty severe global sell-off. And I think amidst that sell-off and amidst the volatility and the dips and the increases that we've seen, there's a lot more attractive price points, and I think a lot more valuations that people are finding interesting. So some of the opportunities we explored from a growth perspective were US technology stocks like the Magnificent Seven. We also looked at cybersecurity and cloud computing as other growth opportunities for investors. Then when for a lot of investors that were looking more for stability as opposed to growth in their portfolio, defensive sectors come into play over here. So things like consumer staples, things like healthcare, things like utilities, and to a certain extent, also financial services companies. So that is, what we're looking at from a growth versus defensive perspective, and predominantly in the United States. Now, at the same time, going a little bit further to other markets, right? People are looking at Europe for, I would say, more long-term stable growth. And then people are looking at more emerging markets like China for growth, I would say, not necessarily stability. Emerging markets, the main characteristic of them tend to be more volatile than your more developed markets. But that's definitely a place where a lot of people are looking to diversify. And I'd say that's what we're looking at from an overall equity standpoint. But Michael, we also looked at things like gold, right? When you look at things like gold, historically has been, a bit of a safe haven. A lot of people use it as an inflation hedge. A lot of people use it when there's times of market volatility. Gold has been on the rise this year, significantly outperforming other asset classes. So it's an interesting, one to take into consideration too. And then also cryptocurrencies and Bitcoin, right? We've seen investors, even though crypto's taken a decent hit, we've seen a lot of investors start putting money towards cryptocurrencies. So another way to diversify a bit further, but obviously consider the risks that are involved with that. And I also wanted to highlight like all of the ETFs, all of the cryptocurrencies, all of the exchange traded commodities, all of the stocks that we've mentioned today are listed on Sarwa Trade. I know we've got a question about that. Are some of these international ETFs available on the Sarwa app? So every single thing on purpose we have gone through is available on the Sarwa Trade application. So if you do want to get exposure to them, that is an option. Awesome. So Michael, why don't we go into the Q&A now? So we've got
Yep.
a questions over here. So we've got a question from Anonymous who's asked, really good question. When should one consider pulling out from the stock market eventually, especially if there has been gains made over a period of time? So I'm happy to take this one because I would say it's a pretty nuanced answer. And there's a bit of a balance way that you need to think about when somebody might consider pulling out of the stock market or at least de-risking, especially after gains, right? And I'd say the first thing is, look, if you're close to getting, to needing those funds, in the next couple of years, if you need that income for retirement, for a home purchase, for educational expenses, whatever it might be, that could be a good opportunity to get out of, your position, especially if you're in the green. Something else, like if you've hit a personal goal, a milestone that secures financial independence, that you've hit a target number for retirement, whatever that might be, amazing. But I'd also say, look, if your risk tolerance or your situation has changed, it also might be worth potentially looking at changing up, those holdings a little bit more. Major
Yeah.
life change might justify more of a conservative approach. If market volatility is causing you stress or poor decision making, maybe it's worth rebalancing. But I would say it's healthy to rebalance periodically, right? sell what's overweight, buy what's underweight. You can also take gains incrementally, right? Trimming, certain sectors or certain holdings to lock in profits while still staying invested.
Yep.
So these are some of the things that you can do. But what I would say is don't just pull out because the markets are volatile or media headlines are scary, and avoid trying to time the market unless your timing is aligned with your financial plan. I've been
Mhm.
having a lot of conversations with clients this week about their portfolios. And I think it's really good to have an idea of what your investment strategy is before investing, right? Think about what guides your investment decisions, think about your time horizons. And I think usually then you'll be able to answer those questions a bit more in terms of when you can pull out and maybe put those funds towards something else. Michael, I don't know
Yeah.
if you want to add anything to that.
You kind of touched on it about the rebalancing. If we look at it from a portfolio manager standpoint, institutional client, they always have a strategy. They have a bit of an asset allocation. If you're running a concentrated portfolio, maybe you want to have 20 or 30 stocks. There will be upper and lower caps that you must generally stay within. So if you have one or two stocks that have been performing very, very well, they generally have to trim from a fund perspective point. So if we try to run it as a fund, investors should look at the extreme winners, not sell them out, but just bring it back into in line to what you think as a upper limit is, and that really depends on how many different stocks you have in your account. You should either equal weight them or have some kind of idea of why you are holding such a large amount of XYZ and just rebalance back to that core amount. I mean, that's just downside risk. If you have 20% of your portfolio invested in one stock, if that stock goes down by 50%, that's a 10% hit, right? So just kind of managing the downside and understanding, where you can trim, reallocate. We talked about this 90 days might give you an opportunity to say, hey, maybe I was a little bit too exposed to mega tech, or I wasn't exposed enough and I should buy more in certain areas and balance it off. So yeah, it's about rebalancing and looking at your asset allocation or just your mix.
Yeah, great answer. So we've also got another question here from somebody who's asking, what are the top cybersecurity firms in the market? Now, we covered what a really good ETF is for that, which is the First
Mhm.
Trust Nasdaq Cybersecurity ETF, CIBR. There's two that that I always hear about, Michael, in terms of
Yep.
cybersecurity companies. One is Palo Alto Networks, and another one is CrowdStrike. I hear a lot about these two companies, and I know that both of them are part of that CIBR ETF.
Mhm.
But I think within that ETF, there's a lot of different holdings that do cover cybersecurity companies as well. But those are two that I can think of that are top of mind, that have had a lot of attention and a lot of investor demand.
Yeah, I think CrowdStrike last year got a bit of attention for the wrong reasons.
Yeah.
That possibly might have caused the big outage in global outage with the Windows update. I think their stock dropped quite a bit in one day, but rallied back hard. So yeah, they are definitely one of the winners and like leaders in that space. Palo Alto, yeah, quite a few different names. Like if you want to look at individual names, you can go right onto that CIBR ETF and look at their top holdings. It'll give you all the names. So that's one of the good things about the ETFs, or even funds. You can find out the underlying holdings, and you might try your hand at constructing your own portfolio, or just take it easy and just buy the ETF. It's all up to where your views are, where you want to test your thesis.
Yeah, and look at what I've just done is I've actually shared to everybody on the chat right now the sector tracker. So
Mhm.
time you can actually go through the sector tracker and look at different sectors that obviously how they've been performing, and then you can also look a little bit deeper into them and to see some of the underlying companies and specifically how those underlying companies have done. It'll give you a better idea as to what you might be investing in. So I think that's also something worth looking at when you have the time. So we've got another question over here. Somebody's asking, at the moment, we have around 10 halal ETFs, and the majority is concentrated on US markets. So what would you advise if I want to be more exposed to other markets or industries, but be Sharia compliant?
Yeah, I mean, that's in that Sharia compliant space, the halal space it's quite limited. There are a few world MSCI world or MSCI or FTSE equivalents, and that's really going to give you it's global, but it will have US exposure as well. So my suggestion is always to look at the underlying ETF, and most of the ETFs, be it an iShares or anything, they'll give on the website will give you a geographic breakdown, and just to understand what that looks like. Even an all world ETF will have probably 55 to 60% in US exposure. So I will actually have to look. Off the top of my head, I don't know if there are any specific developed markets ex-US halal ETFs. I will have to dig one out if we don't have one.
Yeah, you know what? I'm also not aware that if there are any that are ex-US that are Sharia compliant specifically, and I think
Mm.
unfortunately there's not a lot of options when it comes to that because at the end of the day, the US economy does dominate the global economy, and as a result of that, asset managers will usually place a US exposure, and
Yeah.
automatically when you are dealing with Sharia compliant investments, a lot of the companies might not be able to be included in the portfolio or into the fund,
Mhm.
so naturally they tend to include US companies in there as well. But that's more on the equity standpoint. I think what a lot of Islamic investors also do is they get some more exposure to things like Sukuk. There's some Sukuk ETFs. There's also things like gold. Like gold has been having a stellar year when you look at performance so far. So look, it's not necessarily a different market from an equity standpoint, but you can diversify a bit further from an asset class perspective that is exclusive of the United States. A lot of the Sukuk instruments and the Sukuk ETFs are, their issuance is not necessarily in the United States. It's usually in, local, I mean, not local, but in this part of the world, also in Malaysia and other places. And then gold as well. A lot of Islamic investors actually use gold as, a tool to invest.
Yeah. That gold has made a lot of sense. And also that there are some Sharia compliant REITs as well. But again, we'll have to find one and see if it's on our platform. I know
Yeah.
it's not the easiest things to find right now, Sharia compliant investments.
Yeah, so we've got a question from Lamas who said it would be great to have more info on rebalancing, specifically for DIY investors, maybe in your next webinar. Lamas, we hear you loud and clear. That's a great suggestion. So, we can definitely, whether it's in the form of a webinar or whether it's in the form of an email, or even a video, we can definitely look to develop some content and some information about rebalancing for DIY investors. I'll be honest, Michael, this is the question, or not necessarily the question, but this is the concern I see the most with DIY investors, struggling to rebalance, not only from an emotional standpoint, but also from the actual act of rebalancing, right? Do they do their rebalancing based on time? Do they do it every month? Do they do it every quarter? Do they do it based on, portfolio drift to their asset allocation? There's a lot of ways that people do it. So it's a really good question, and I think we'll definitely try
Yeah.
to create some information on that for you.
Yeah, it's one of those things that whenever you have to do something yourself, that emotion, that behavioral finance aspect of it creeps in. Am I selling the winners too soon? Should I just hold on? I can tell you, had I rebalanced mid-November, early December, I would have been way better off. But I was looking at it, I was like, look, I think we're just going to let the winners run. And I'm sure you can figure out which winners I held on to, probably for a little longer than I am. Those winners have now become a bit of losers, but we're holding. So rebalancing is just the act of trying to be systematic about it. If you want to do it on a monthly basis, that may or may not be, it really depends on what you're holding, or quarterly, but try to be disciplined about it. Like I am holding 10 stocks, I want 10% in each stock, and then every month or every quarter, I am going to realign it back to that 10% equal weighting. Or have some methodology that you want to develop. I mean, there's a lot of great resources online. It's the age of the internet is pretty awesome. You can even ask one of the the chat GPTs or Copilot or DeepSeek to give you a bit of a beginner's guide on how to construct a portfolio and best practices in rebalancing. And it'll actually give you ideas on that, on frequency, you know, do you actually weight it, or do you bring it back to equal weighting? So there's tons of resources. It's pretty amazing right now.
Yeah, I know, like there's a lot of resources out there. So, I think we're in a much better age when it comes to financial education and the resources that are available, and we're hoping to kind of contribute to that as well. Um,
Yeah.
but look, I think that's kind of all the time we have, and I think that's all the questions that we have so far. But everybody, thank you so much again for joining us. Look, we've shared, as I said, the sector rotation information as well. We're gonna have a recording of this webinar, so everybody who's attended, they're going to get a recording of it also. So, any of these ETFs that we've mentioned and any of these opportunities, you can actually take a look at it in the recording. But look, just wanted to say thank you again for joining us. We really hope that you're walking away not just with a clearer view of the market, but hopefully a calmer mindset,
Yeah.
and one that's focused on actually staying intentional over the next 90 days as opposed to reactional. I think volatility, Michael, you'll agree it's constant, but so is opportunity, especially when you're diversified, disciplined, and I think anchored in a solid plan. But if anything you heard today sparked any questions, or if you want to have a deeper look at your investments, feel free to reach out to us. Obviously, more than happy to help. But Michael, thank you for doing this with me. It's always a
Thank you.
pleasure. And thank you everybody for joining today.
Really enjoyed it. Thank you everyone for joining us. See you next time.
Thank you all. Have a great day. Take care.